This is a bookbull summary of the book Millennial Money by Patrick O'Shaughnessy. Have you ever thought about your retirement? Chances are, most of us haven't given it much consideration. We often believe that retirement planning can wait since it's decades away. But here's the truth. The mindset is completely off the mark. Regardless of our age, thinking about the future is crucial, especially for us millennials, the generation born between 1980 and 2000. If we want a peaceful and comfortable retirement, we need to take action right now. Trust me. Life as pensioners won't be a walk in the park if we neglect this essential step. So, what's the secret to securing our financial future? It lies in the stock market. Yes, you heard that right. Investing in stocks can be the game changer that sets us up for success in our golden years. In this video, we'll dive into the fascinating insights from the book Millennial Money and explore how you can navigate the stock market to build a secure nest egg for retirement. Get ready to unlock the keys to financial freedom and embark on an exciting journey towards a prosperous future. Secure your financial future. Start investing early in the stock market. Imagine yourself 50 years from now. Do you see yourself living comfortably with a healthy nest egg or struggling with a meager pension and a constant financial stress? The choice is clear, and to achieve long-term financial stability, you need to take action. Contrary to popular belief, a savings account isn't the best path to financial security. In fact, the interest rates on savings accounts are often lower than inflation rates, meaning your money loses value over time. So what's the solution? Start investing in the stock market as early as possible. Don't underestimate the power of early investments. When you start young, your money has more time to grow. For example, if you invest $10,000 annually in the stock market with a 7% annual return, you could accumulate $4.7 million by the time you're 65, but only $1 million if you start at age 40. Unfortunately, many millennials hesitate to invest due to the impact of the 2008 financial crisis. However, by avoiding risk, they may miss out on the potential rewards of early investments. A 2014 survey revealed that only 28% of millennial money was invested in stocks, compared to 46% for other generations. Millennials' financial challenge, navigating rising debt and an aging population. Let's talk about our financial future and why it's important to start investing early. You might have heard that public debt is on the rise and our population is getting older. What does that mean for us? Well, it's not looking too great. Think about it this way. People are living longer, which means the government has to spend more on pension and healthcare. And with baby boomers retiring, these costs will only go up. Unfortunately, there's no guarantee that the future generations will receive the same retirement benefits. Our government has to balance its accounts just like any business, and right now it's not looking good. There's a massive $9.6 trillion gap between projected benefit spending and expected tax revenue over the next 75 years. So what can we do? We need to rely on ourselves and start investing in the stock market early. It's our best shot at securing our financial independence and a comfortable retirement. If you're finding this video to be enjoyable, show your support by liking it and subscribing to my channel for even more fantastic content. Your encouragement means everything to me and drives me to keep creating videos for you. Expand your horizons. Invest in stocks worldwide for long-term success. So you made the decision to dive into the world of the stock market investing. Now, where should you begin? The key is to spread your investments across companies worldwide. Many people make the mistake of putting all their money into a few companies in a single country. However, this strategy carries significant long-term risks. If the stock market in that country falters, you could lose everything. Let's take the example of Japan's Nikkei stock market index. Back in 1989, it seemed like a booming market, growing at an impressive 30%. Many investors poured money into it, only to witness the bursting of an unstable financial bubble in 1991. By 2013, the value of their investments had plummeted by half. Clearly, putting all your eggs in one basket is dangerous. Yet people do it because they get caught up in the stock market bubbles or prefer investing in familiar companies. To succeed, you must step out of your comfort zone and diversify your investments across diverse regions. This approach safeguards your money even if a company or economy collapses. Remember, diversification not only protects your investments, but also allows you to benefit from changes in global currencies. For instance, if you invest in Samsung, a South Korean company, and the South Korean won strengthens by 6% against the US dollar, your investment's value will also increase by 6%. So when you invest in stocks, you're not only investing in the company, you're also investing in the currency. Maximizing your investment earnings. Diverge from the herd. If you want to maximize your earnings, it's time to break away from the mainstream investment strategies. Many people rely on the recommendation of so-called experts, who often advocate for the sector leader strategy. This strategy involves buying shares of the best performing companies on a market index, like the Standard & Poor's 500, which includes the largest listed companies. To implement this strategy, you can invest in an index fund that automatically tracks the 500 biggest companies. Index funds are affordable and secure, making them an attractive choice. However, if you truly want to earn the highest returns, you need to think differently. Index funds may offer decent returns, but they can't beat the market, especially when aiming to match market index returns. Moreover, major companies tend to underperform once they reach the top. Investing in these firms might not be the most profitable choice. Instead, consider the sector bargain strategy, where you buy the cheapest stocks rather than the best. Counterintuitively, these approaches often outperform the leader strategy in the long run. For example, since 1979, the Russell 3000, which follows a bargain strategy, has outperformed the S&P 500 by over 1,100%. The Millennial Money strategy, investing in valuable companies for maximum returns. Want to make smart investment decisions? Here's a strategy that can help you maximize your future returns. It's called the Millennial Money strategy, and it's all about buying cheap stocks from valuable companies. So why is this strategy the best? By purchasing inexpensive stocks, you can stretch your investment and potentially earn higher returns down the line. But remember, you're not just looking for the cheapest stock available. You want to find a true bargain by ensuring the company has value and that its share price is likely to rise in the future. To evaluate a company's long-term prospects, focus on its earnings and cash flow. Compare the stock price to the cash flow to gauge its value. Look for companies with secure finances and a low share price. Boost your strategy by identifying stocks that are riding a wave of momentum. Seek out cheaper shares that have been significant price increases in the past 6 months. Combine value seeking with momentum to carve out your investment approach. And here's some convincing data. Since 1972, companies matching these criteria have outpaced market growth by a factor of 2 annually. Overcoming investment instincts. Harness the power of automation. Did you know that as humans, we're naturally prone to making investment mistakes? It's in our wiring to be irrationally fearful and overly sensitive to potential losses. Take, for example, a study conducted at Stanford University. Students were asked to make investment decisions using a coin toss, where they could either lose $1 or win $2.50. Surprisingly, after experiencing a loss, students were hesitant to invest again, even though there was a 50% chance of a high reward. This irrational behavior is also prevalent in the market. Many investors buy when the market is at its peak due to the fear of missing out, and sell when it hits rock bottom out of fear of losing everything. These actions go against the basic principle of stock trading, buying low and selling high. However, there is a way to overcome these instincts: automation. By setting up an automatic payment system from your bank account to your investment account, you can remove the influence of your instincts. You determine the amount and frequency of the payment, as well as the specific fund to invest in. By following a predetermined strategy systematically, without letting your instincts interfere, you can better manage your investments. Automation is a powerful tool to help you separate emotions from your financial decisions. Unlocking investment success, embracing long-term thinking. Many investors make the mistake of selling their shares as soon as they see a decline in their value. However, this short-sighted approach rarely leads to profitability. Our human biology, specifically our emotional center in the brain, drives us towards decisions that provide instant gratification. During financial crises, this instinct leads investors to seek refuge in bonds, which offer short-term stability and protect against losses. Even professional investors fall victim to short-term thinking, focusing on short career horizons and immediate results. However, when we examine the data, it becomes evident that the most profitable investments require patience and time. It takes approximately 30 years for investments to fully mature and yield significant returns. Despite the market's short-term fluctuations, it generally follows an upward trajectory over the long run. Over one-year periods, stocks lose value around 31% of the time, but indexes of stocks never incur losses over a 20-year span. On the other hand, bonds have a 50% chance of losing value over the same period. To achieve investment success, it's crucial to embrace a long-term thinking and resist the urge for instant gratification. We hope this video provided valuable insights and information for you. Are you currently investing in the stock market for your retirement? Or are you hesitant due to the risks involved? Let us know in the comments. And if you learned something new in this video, make sure to hit the button and subscribe for more videos. Thank you, and until next time.